this. That means they um this is something they will rely on, or this is something you need in your organization, in your business, or if so. Welcome once again, and this is the first webinar for this year under the Institute of Export and International Trade. So a little bit about the Institute of Export and International Trade. We offer aim high in the field, and we also aim to empower businesses and government to strive in the international trade landscape. And once again, we know this will be an exciting session for us all. So before we start, or before we have our keynote speaker here with us, Dr. Bamidele, please don't leave. It's going to be an amazing one. And also, please, all microphones should be muted unless it's time for question and answers. So we'll be moving now to the bio of the speaker. So we have Dr. Bamidele Ayemibo, who is widely known as consultant, keynote speaker, and expert in international trade finance. So as an AFTA ambassador, and one of Africa's foremost authorities in trade education, Bamidele finance across the continent. So his innovative contributions to the field, including the export business readiness assessment program, have earned him international acclaim as one of the most comprehensive of Treaty Impex Consulting, the parent company of Treaty Impex Academy. So under his leadership, Treaty Impex Consulting has become an partner of the London Institute of Banking and Finance. So his firm is dedicated to enhancing trade knowledge, facilitating trade funding, and expanding trade volumes across at least 25% of African nations. So he holds a doctorate in international business with law from Stanford University. He's also among the first 10 certified specialists in demand guarantee in Africa and the first in Nigeria. So his expertise spans international trade finance, trade rules, bank businesses, and financial institutions. Then finally, we have Bamidele Ayemibo, is committed to transforming Africa's trade ecosystem by empowering businesses with practical export solutions, trade finance knowledge, and strategic growth frameworks, professional development, and innovative trade solutions that foster economic growth across Africa. So if you paid attention to the bio of our speaker today, you will know that this session on trade compliance, pad your pens ready because it's going to be an amazing one. And I also look forward to learning from Dr. Bamidele Ayemibo. So thank you so much, sir, for honoring the invite from the Institute. We appreciate you so much. So right now, I think over to you, sir.
All right, Victoria, thank you very much. Thank you very much, everyone, for joining. We hope to make this a more consistent program. This is the first in the series, like the admin of the Institute has stated. We hope to keep us abreast of what is critical, both for our job and career, and whatever it is we are doing within the trade space. So today we are looking at Trade Compliance 2026, mistake trade professional can't afford to make. So let's start first of all by defining compliance. Trade compliance is a systematic process of ensuring that import-export of goods adhere strictly to laws, regulation, rules set by government agencies, both the origin and destination countries. Both the origin and destination countries. At its core, it's about making sure a business is legally permitted to move a specific product across borders. And this involves accurate product classification, product valuation, obtaining correct licenses, permit, and paying the appropriate tariff, duties, screening buyers to ensure they are not on any restricted and sanctioned party list. And you agree with me what's going on in the world. In fact, a country like Russia, country like Iran have been on this list for a long time, and not just as a nation for a number of their products, and even some oligarch in those countries, some business people and businessmen in those countries. And so the interesting thing about trade is that the landscape is always changing. And the reason is because a lot of countries depend a lot. I mean, look at what is happening in the world today. Look at what is happening in Strait of Hormuz and the impact. In fact, I don't know how true it is. There is a vessel that I heard tried to pass, a Pakistani vessel, an oil vessel that tried to pass without authorization and it was blown up. I saw the video online, but because it's trade, and someone said, sorry, it's war, and in war, that the first casualty in any war is truth. So we really don't know how true that is. But just to let you understand how important this sector is to nations, actually, because a lot of nations are affected, including Nigeria, just because of what is happening in one part of the world, because we now have intercontinental value chain in which countries are depending on each other. So compliance is a very important one. In fact, some of our Nigerians that have gone to America, Europe, Canada, will tell us that some of them that are in trade in Nigeria found themselves there in compliance. And the reason is because of the level of fine that they receive from government whenever there is a violation. The organization would rather put more people in compliance to ensure more eyeballs can see some of these transactions and ensure nothing goes or pass them unnoticed. Just to ensure that at the end of the day, they are able to ensure that the transaction they don't violate the law and then receive billions, sometimes billions of dollars in fine from the government of the country where they are. What trade compliance means today? Trade compliance now goes beyond basic documentation. It includes adherence to international rules like UCP and Incoterm, compliance with sanctions, export control, and anti-money laundering laws, ensuring transparency across the entire transaction life cycle. Entire transaction life. In simple terms, it's about doing trade the right way, legally, safely, and efficiently. Doing trade the right way, first legally, because you can be violating the law of the land if you don't abide by the rule or regulation of the country, legally, and then safely, and then efficiently. What are the key drivers of compliance in 2026? Number one, financial crime. Increased focus on trade-based money laundering and illicit financial flow. Another key driver in 2026 is global regulatory pressure. Governance and regulators are tightening oversight on cross-border transactions. Digital trade evolution, the rise of electronic documentation, automation, and AI-driven compliance monitoring. And then geopolitical tension, and that you can see with what is happening in the West Asia, with what is happening with Iran, Russia, and the US, and even the countries within the Gulf countries, and then ESG and sustainability, environmental and ethical sourcing requirements are now part of compliance. And this is another area that we are not really taking we need to begin to take it seriously and understand what is going on in that sector. The beauty of trade is when the world is ready to do something, it doesn't matter which country you are. If you are not ready to go along, they leave you behind. So everybody is forced to tag along. And it's important you are aware of this right ahead in order to ensure you are prepared to handle all the issues and challenges that comes with it. What are the core areas of trade compliance? Sanction compliance, screening all parties, vessels, and routes involved in trade transactions. Documentation compliance, ensuring accuracy and consistency involving bill of lading in certificate. Custom compliance, proper classification, valuation, and declaration of goods. Trade compliance, adherence to rules governing letter of credit and collection. Anti-money laundering and trade-based money laundering. Monitoring, detecting suspicious trade pattern and fraudulent activity. Why trade compliance matter more than ever? Why does it matter more than ever? Number one, prevent financial loss. Error in trade document can lead to non-payment of costs and shipment rejection. But avoiding regulatory penalty, like I said, a number of businesses, particularly outside the country, in Europe in particular, in America, regulatory penalty, non-compliance can result in fine, sanctions, and business restriction. Enable access to trade finance. Bank requires strict compliance before financing transaction. Build global credibility. Compliant business are more trusted. No business want to deal with, no bank want to deal with other banks or businesses that are not compliant because they're going to put them in trouble and they would rather not treat. That's why sometimes you see some transaction, the bank might have confirmed and it's time to pay, and the bank is saying, I'm not interested again. I'm not interested. And he's not going to treat. And he's not going to disclose the reason why he's not treating, so that the owner of the transaction will not know that they are now watching them and they're declining their transaction. Support business growth. Smooth compliance process enable faster and more reliable trade operation. What are the emerging trends in 2026? AI, automation and AI. Compliance checks are increasingly automated to increase human error. And for those of us in trade, for some of the bankers that are here in trade, and you are doing document examination, AI is taking over that job. AI is taking over that job. And maybe before the end of this decade, we might begin to see that entry Nigeria because of the human error. In fact, globally, ICC said out of 10 documents presented, 7 are discrepant. And with AI coming in to do document examination, because we are going to very soon get into electronic presentation in which the letter of credit is issued electronically already, but the documents are now going to be presented electronically. It's already happening and it's being powered by blockchain technology. And with that in place, the implication of that is the fact that we might not need human being to do physical examination of document again. Real-time monitoring. Transactions are screened instantly across multiple risk parameters, and then digital documentation. Electronic bill of lading and digital trade platform are becoming standard. COVID taught us a very big lesson. COVID made it so difficult to be able to present documents, and some transactions were affected. You had a lot of demurrage being paid. Some were able to find a way around it, amending the LC to allow copy presentation and doing teles release at the port. Some are using shipping guarantee to be able to get the goods out. But now, December 2020, the first fully digitized trade transaction took place between New Zealand and China. And it was through HSBC, powered by Wave, a particular technology company in New Zealand. The fact is that fully digitized trade transaction is currently going on. In fact, ICC came up with the uniform rule for digital trade transactions. So we now have URDTT, uniform rule for digital trade transaction. The idea is to ensure that, so if I am going to allow electronic presentation, it's now going to be easier to be able to know what are the responsibilities of the parties involved. In fact, last year, CBN organized a seminar on digitalization of trade. Before people would say, when will this enter Nigeria? Is CBN even serious? Are they considering this? How will CBN even do this? I was shocked. In fact, at the event, I was one of the speakers at the event, and I remember asking the participants, and I told them that, do you think CBN is ready? And some people were saying they are not. And CBN said they are ready. They are preparing for it. 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 What that means is that, the way it is in Nigeria, they will just issue a circular and then tell you what you need to do and abide by within a certain period. And before you know it, I'm basically saying that it's on our doorstep. It's going to happen. Look, we don't even have a choice, actually, on digitization of trade. We don't have a choice. The world is moving in that direction. And remember, trade is international trade. International trade. That means you can't do it by yourself. You do it in conjunction with other people around the world. So if they are moving on, you have to tag along. If they are moving on, you have to tag along. And that's what I see happening within this space very soon. Integrated compliance platform system. Compliance is embedded into core business and banking system and data-driven risk assessment. Advanced analytics are used to identify anomalies and risk. So we expect that going to the future, it should be a lot better. And that means, you will have heard AI is people are going to lose jobs. People are going to lose jobs. Sincerely, it's going to create new jobs, but definitely it's going to affect some skills. What that means is it's important also you prepare for this, because knowing fully where this is the possibility, then you need to reskill, retool to also become relevant to your organization in other areas, so that when AI is taking over, you are still relevant. Someone said, don't be too loyal to what is working, because it's going to change. The change is on us right now. And don't stay where you are. Think of the future, acquire skill to remain relevant rather than staying in that location. It's just like the way we've seen ATM. You don't see queue in banks again, the way it used to be in those days. If there is queue now, maybe there is an issue with the platform or with the ATM. But now you see queue more at ATMs, and that queue will be in ATM where you have few ATMs, because there are many ATMs and you can withdraw from other banks. Key challenging professional phase: keeping up with constantly changing regulation. And you agree with me, the way regulatory environment is changing for trade. Managing complex multi-country trade transactions. Now, there are issues around presentation of documents for a transaction from the Middle East, because flight is being cancelled. There's disruption. Courier are not able to present those documents. By sending them to Nigeria, the goods are arriving. What do? Some banks are already finding a way around it. They're already using copies, amending the LC to allow copy presentation and allowing also the goods to be released based on terrorist release. Find a way around it. And all these are happening. Why? Because the world is interconnected. What is affecting others is affecting you. Balancing speed of trade with compliance requirement. Balancing speed of trade with compliance requirement and high cost of implementing compliance system. So let's look at some of the pitfalls, which should be major focus of this. I have about 10 of them. I'll move very fast because of time. Pitfalls that we must avoid in 2026. Ignoring sanction screening beyond the buyer. Ignoring sanction screening beyond the buyers. So what's the mistake here? This mistake occurs when professionals screen only, particularly bank, the buyer, the importer, and fail to screen the other party involved in the transaction. So you are dealing with a customer for the first time, and you have screened the customer, you've done your AML, but you are ignoring the other parties involved. Modern trade transactions involve multi-stakeholder, including exporter, intermediaries, agents, shipping companies, vessels, port of loading and discharge, bank and financial institutions, insurance and logistic providers. By focusing only on buyer, businesses create a compliance gap, exposing themselves to hidden risk within the transaction chain. Why is this a serious problem? Regulatory risk. Sanction law are strictly enforced globally. Involvement of any sanction party, even indirectly, can lead to heavy fine or penalty. Financial risk. Payment may be blocked or delayed or frozen by banks if sanction entity is detected during the process. Operational risk. Good may be seized and shipment delayed if sanction vessel, route, or port is involved. Reputational risk. Association with sanctioned entity can damage credibility and affect future business relationship. Increased scrutiny. Regulators are now expect end-to-end transaction. Now expect end-to-end transaction. Now expect end-to-end transaction transparency, not just counterparty. Not just counterparty. End-to-end transaction transparency, not just counterparty. Not just counterparty. Now, how do we prevent this mistake? Screen all parties. Conduct sanction screening in all entities involved, including intermediary, vessels, port, and financial institutions. Number 2, Perform vessel and route screening. Ensure that shipping route and vessel are not linked to sanctioned jurisdiction or entity. Number 3, train staff regularly. Capacity building. Capacity building. Capacity building. I engage with a number of institutions, and sometimes it's unfortunate that sometimes, and I think it's important for us as individuals, even if the organization is not because of budget, for us and our career, it's important we do something, which is why I appreciate all of us that are able to join the Institute's webinar today, to be able to also develop ourselves. Why? Because, remember, don't be too loyal to what is working because it's going to change. Use automated tools. Implement compliance software that provide real-time sanction list update and flag high-risk transaction. Adopt a risk-based approach. Focus on enhanced due diligence, on high-risk countries, unusual trade pattern, and complex transaction. And of course, maintaining audit trail, keeping proper record of all screening activity and compliance decision for regulatory review. Key insight. In 2026, sanction compliance requires full transaction visibility. It's no longer enough to know your buyer. You must understand and screen every parties involved in the chain. Every parties involved in the chain. Second pitfall, poor understanding of letter of credit rules. Poor understanding of letter of credit rules. The mistake, this occur when professional banks or experts do not fully understand how letter of credit operates. Even though this rule is, the rule is about 20 years old. Yeah, 20 years old. By July 1, 20 years old. 20 years old. But, of course, you have a lot of people leaving and new people coming in straight from school, find themselves in this environment, either in the manufacturing sector, in the trading sector, or within the banking sector. A letter of credit is governed by international rule of course UCP, which require exact compliance with document terms. Common gag include misunderstanding, strict compliance versus discrepancies, incorrect interpretation of LC terms and condition, and poor document preparation. My recommendation for document examination is for you to master international standard banking practice to be able to ensure you have a good understanding of how strict should be. When you say strict compliance, how strict should that strict be? How strict should it be? How strict should it be? Strict compliance. How strict should it be? And that has been defined in the international standard banking practice. How strict should be, how strict should be is already defined in the international standard banking practice. In the international standard banking practice. Many assume that if goods are shipped correctly, payment will automatically follow. This is not always true in LC transaction. Why is this serious? Payment risk. Payment risk. So it's important, some people find themselves on trade desk and some have not read UCP 600 and probably have not seen international standard banking practice. The essence of a conversation like this is to let you know that a rule like this exists, number one, for you to begin to learn, because, I used to be a banker. When the ships are down, it doesn't matter whether you are aware or not. Some organizations they're very ruthless on ensuring that someone take responsibility. And for one reason or the other, someone have to bear the responsibility of whatever has happened to the transaction. And sometimes you don't want that to be you, because you are expected that, in fact, you are seen by the management as professional in that area. So you really cannot say you are not aware of it, because that's what you do, even when you have not been trained, which is why we can't use that as a reason why we are not able to do what's expected of us. Payment risk. Bank pay based on document. Any discrepancy, even small, can lead to non-payment. Financial loss. Expert may incur cost of production, shipping, and logistics, but fail to receive payment because of documentation error in its documentation. Because of error in its documentation. And sometimes banks might be financing this. Sometimes it's not just the customer involved. What if the bank is financing? What if your bank is financing? What if the bank is financing? Dispute and litigation. This is a very common one. Recently, I was in a session with some banker on trade dispute, on a letter of credit court cases, rather. And there are plethora of that in Nigeria. Why? Because of lack of understanding of trade rules, making us to take some decision that ought not to be taken in the first place. Misunderstanding of LC rules often lead to legal dispute between banks, seller, and the buyer. Operational delay. Discrepancy can cause delay in document acceptance, affecting cash flow and business operation. Reputational damage. Frequent documentation error reduces credibility with banks and international buyers. How do we prevent this? How do we prevent this from happening? Train on LC rule. Train on LC rule. Ensure all relevant staff are trained on UCP. I know some organizations that do this every morning because they want to ensure everybody is fully abreast of what the rule actually says. Use document checklist. Implement standardized checklists to verify accuracy of all documents before submission. Conduct pre-submission review before internal audit and document. This is particularly important for exporters. Perform internal audit of documents before presenting them to the bank. This is particularly important for the traders themselves. And for traders that are not very skilled in this regard, engage your bank. A number of banks have competent people that can do this on your behalf, and that will be another customer service they can do for you, because you see export customer presenting discrepant document. Even though they have an LC, then payment is delayed because of discrepancy in the document. Pre-LC time check. Carefully review LC condition before shipment to confirm all requirements are met. Now the customer, a mentee recently that wanted to do export transaction, got an LC, and I saw some terms on his LC. But quite frankly, he got it through a bank, and of course, the account officer does not know much about it. And the people that receive it in the head office most likely did not check it, or they did not even ask him, because there are some of those terms that the customer cannot meet, some of the documents they were asking for. And it could have shipped only to have issue with payment. And in some cases, the bank is financing the transaction. Engage expert. Work with experienced trade finance professional. If you are importer here or exporter, it's important you work with your bank, particularly the trade finance professional in your bank, not the branch. The people in the head office that will be able to assist you. Leverage bank guidance. Maintain close communication. You see that? With the advising or issuing bank for clarification on LC terms. Key insight. In trade finance, document does not trigger payment. In trade finance, document not good. Document not good, trigger payment. So a strong understanding of the LC rule is essential to avoid costly error and ensure successful international transactions. Let's look at the next one. Weak documentation control. Weak documentation control. We're looking at the pitfalls. Weak documentation control. What's the mistake here? Weak documentation control when the professional fail to properly prepare, verify, and manage trade document in export transaction. International trade rely heavily on documents such as commercial invoice, bill of lading, packing list, certificate of origin, inspection report, and insurance certificate. Common issues like inconsistent information across document, typographical error or missing detail, late presentation or submission of document, and lack of standard review process. In trade finance, especially under UCP 600, even minor discrepancy can lead to document rejection. Now, particularly, I know for import, and this is for me, this is a big challenge for professionals on import. They call it negotiation, even though I have issue with the word negotiation. If you look at it in the context of UCP, on negotiation desk, most of the time, we don't get to improve our skill in document examination because the customer already say wave. So wave discrepancy. But that is robbing us of something. It's robbing us of document examination. Now, when you now look at export, it now is what? The bank is financing an export transaction, but the person on the export desk is not as savvy in document examination as the guy on negotiation desk. So the bank is funding, but the document going abroad are discrepant documents. And that's going to affect payment on a transaction the bank is funding. But those discrepancies could have been cured in Nigeria before the documents are sent abroad. But because those on the desk are not as good with document examination as those on the import document negotiation. What is this? Why is this problem serious? Again, payment risk. Bank rely on document. Error can result in non-payment or delay payment. Shipment delay. Incorrect or incomplete document can cause delay. Financial loss. EFTA can incur demurrage. Remember, the bank can be funding. This is speaking to the fact that we now have to go beyond, even though we are not, even if you are not funding, it can be an added customer service. But when the bank is funding, this is now very important for you to check. Exporter may incur demurrage, storage charge, or even lose goods due to documentation error. Compliance risk, inaccurate document may violate custom regulation, leading to fines or penalty. Reputational damage, frequent documentation issues reduce trust with banks, buyers, and logistic partners. How do we prevent this? Implementing standardized process. Standardized process. Develop clear procedure for document preparation, review, and approval. Adopt dual verification. And this is common with many banks. Dual verification. For payment to be made on any transaction, first of all, you want to ensure that it's not just one person that is seeing this document. Another person is checking it also. So you have 4 eyes rather, not two, seeing it before it goes through. Maintaining proper record. Keep organized and accurate record for audit and compliance purposes. Like some of those transactions now that are taking bank to court, some banks that are able to have better record have case to prove. And those that have lost those records, of course, it becomes a challenge for them in a court of law. Use checklist. Detailed checklist to ensure consistency and completeness across all documents. And this is particularly important for those of us on the export desk who are not day-to-day doing document examination as the people on the import desk. Leveraging digital tools and aligning document with contract terms. In international trade, documentation is the foundation of every transaction. Weak control system can turn profitable deal into costly losses. Precision and consistency are therefore non-negotiable. The fourth pitfall, underestimating trade-based money laundering. This is becoming a big deal. In fact, the reason why kidnapping, terrorism persist in Nigeria is because of this. I was talking to some guys and they said, some Nigerian importers, if they want to do a transaction and they know this will involve them moving money abroad illegally, they know some banks they need to go. They know some banks they will not go to because they know banks that are a bit lax with trade-based money laundering. And the terrorists are aware of this and they're leveraging on it. If we can fix trade-based money laundering, trade is huge. It's huge. I mean, trade is over $33 trillion. Trade in service about $9 trillion. Trade in goods about $24 trillion. Probably about 26, 27 now. We're waiting for data of 2025. It speaks volume as to enormity of what can be hidden in trade transactions. So I can understand. But then we still have to tighten. If Nigeria were to be a place where CBN is very serious on this issue, some bank will have taken it more seriously, which is why International Bank in Nigeria don't joke with this, because their subsidiary have received a lot of fine from their European or American government where they reside. And that makes them take it very, very seriously. What's the mistake here? This occurs when professionals fail to recognize or adequately monitor trade transactions that may lead to disguised illicit financial flow. Trade-based money laundering involves manipulating trade transactions to move value illegally across borders. This can be over-invoicing, under-invoicing, multiple invoicing, misrepresentation of quality or quantity, phantom shipment, to mention a few. Many professionals treat trade transactions as routine operation and do not scrutinize unusual pattern or inconsistency, even when sometimes people can sense it. If you have been dealing with, if you are a document examiner and you've handled several MEX line bill of lading, when you see a fake one, you can identify it. And you know that this might be money laundering case. It's a phantom shipment, no shipment, but here is a document in your hand. And you have the opportunity to send a suspicious transaction report at that point so that the compliance team can investigate further. Why is this a serious problem? Regulatory risk. Authorities are increasingly enforcing trade money laundering due to its link to financial crime, terrorism, and terrorism financing and illicit trade. Financial risk. Bank may block or reverse transactions suspected to be trade-based money laundering, leading to loss of funds or disrupted trade flow. Reputational damage. Association with suspicion transaction can damage company credibility and banking relationship. Some banks will not deal with some banks because of this. Some banks will not deal with some banks in corresponding banking relationship because of this. Legal consequences. Businesses may face investigation, penalty, or sanction if found involved, knowingly or unknowingly, in trade-based money activity. Increased scrutiny. Regulators expect businesses to apply enhanced due diligence. Enhanced due diligence. It has to be a continuous one and transaction monitoring. How do we prevent this? Implement transaction monitoring system using tools to detect unusual pricing. CBN tried to do something like this the other time, but everything in Nigeria is politicized, even though it's well intended, but it was shut down. And people that are taking advantage of the system are still taking advantage of the system. Due diligence. Screen and verify all parties involved in transaction, including buyers, suppliers, and intermediaries. Training staff on trade money laundering red flag. Equip teams to identify warning signs such as unusual trade route or inconsistent shipment details. Verify pricing and valuation. Sometimes you are on a desk. You've seen generator imported from Germany. 1,000 kVA of this brand. The last person that imported it at $15,000. Another person is importing the same product and is quoting $100,000 from the same source in the same country. That's suspicious. That's suspicious. Ensure documentation consistency. Cross-check all documents for accuracy and alignment. Adopt a risk-based approach, focusing greater scrutiny on high-risk country, high-risk commodity, and transaction structures. Key insight: in 2026, trade money laundering is one of the most critical risks in international trade. Ignoring it is no longer an option. Proactive monitoring and vigilance are essential to protect businesses from financial crime exposure. There was this case in the UK some time ago that it was so bad that a whole big bank was shut down. As in, the government agency, the authority went to all the branches, and at a particular time, they shut down all the branches, chased everybody out, and locked the door. As in, shut down the bank, as in, lock the door and chase everybody out. The same time, the same day, it wreaked havoc in the financial market. Because the bank has become a fantastic conduit for money laundering. In some cases, you've seen desk officer with their supervisor going to jail or being fined. Why? Because they overlook what they should actually have seen. Number 5, failure to comply with export control regulation. This occurs when exporter, bank, or trade professional fail to identify, classify, or obtain authorization for controlled goods, softwares, and technology before export. Export control restriction or require license for item with dual-use goods, that's for civilian and military use, application or strategic sensitivity. Common failure include misclassification product under wrong HS code, shipping without required export license or permit, exporting restricted to restricted country, entities, end users, and ignoring end use risk, diversion to prohibited uses. Professional may assume goods are non-sensitive and skip proper check. In Nigeria today, you now know that some items, if you want to import them, they will ask you for end use certificate. Why? Because they are dual use goods, which can be used for both military purposes and also for commercial or civilian purposes. Why is this serious problem? Legal risk violation can lead to criminal liability, including fines and licenses revocation and imprisonment. Financial risk. Shipment can be seized or blocked, causing losses, penalties, and contract cancellation. Regulatory risk. Authority may impose sanctions, debarment, or blacklisting and limiting future trade activity. Reputational damage. Non-compliance erode trust with buyer, banks, or regulator. Operational disruption. Investigation can halt operation and delay shipment across supply chain. Across supply chain. So how do we present this mistake? Classify product correctly. Determine accurate HS code and export control classification. Maintain an internal classification database. Obtain required licenses. This is particularly important for the exporter or importer itself. Secure export permit where applicable before shipment. Tracking validity and condition. The beauty is that for Nigeria, we don't have so much restriction on export. Even I think the only one that have been added now is shea butter to the list that have existed for such a long time. And the shea butter seems as if it has come to stay the way it's going. Screen destination. Avoid restriction or restricted or high risk jurisdiction unless properly licensed. Check control limit. Screen goods against relevant national and international control limit. Update regularly. Know your customer. Know your customer. In fact, go beyond that and know your customer business. Some will say know your customer's customer, KYCC. Know your customer, KYC. Know your customer's customer, KYCC. Know your customer's business, KYCB. Implementing compliance procedure, establishing standard operating procedure, classification and licensing and approval with clear accountability. Key insight. Export control are strict and enforceable. Export control are strict and enforceable. Compliance requires knowing what you are exporting, to whom you are exporting, and for what purpose you are doing the export, and for what purpose you are doing the shipment. Ignoring non-tariff barriers. Ignoring non-tariff barriers. This occurs when exporters focus only on tariff and pricing, while overlooking non-tariff barriers that regulate market entry. Even though we have agreements signed, have you ever wondered why? Even though we have agreements signed, AFCFTA, UK DCTS, AGOA, ETLS, and the recent one we had in UAE, SEPA, the utilization is low because there are still non-tariff barriers. Most of those agreements focus on tariff, reduction of tariff, in some cases near zero, in some cases zero completely. But in spite of this, utilization is still low because of non-tariff barrier. And this is important for us as bankers, particularly when you're financing transactions to this destination. NTB includes sanitary and phytosanitary requirements, technical standard and certification, packaging and labeling rules, quotas and inspection, and import permit. Many exporters assume that once tariffs are low or zero, access to market is guaranteed, and that's not the case. We've had cases, I don't know if you heard the news when the government celebrated the shipment we had under AFCFTA. The first shipment. But guess what? That shipment had issues. The shipment had issues. The shipment had issues. But that does not make it to the news because they kill the news on that. They had issue because of this. And it's unfortunate that the AFCFT secretariat did not advise the people very well because I was really shocked when I heard about it on these issues before the goods were shipped in the first place. I'm saying this now for those of us that are banker, for exporter, this of concern. For those of us that are banker, if you're financing, this is something you really must take a second look at, even when there is free entry into those countries. Many sort of assume that zero tariff, the fact that the zero tariff give access to this market. Access to the market is not guaranteed. Failure to understand this requirement often lead to shipment rejection or delay at destination port. Why is this serious? Market access risk. Product may be denied entry if they do not meet regulatory standard of the importing country. Financial loss. Exporter may incur, in fact, they do in this transaction, they actually do incur loss. Exporter may incur losses from rejected shipment, re-export costs, or destruction of goods. Operational delay. Non-compliance can lead to prolonged inspection and clearance delay, affecting product freshness, especially for perishables. Reputational damage. Buyer may lose confidence in supplier who repeatedly fail to meet the import requirement, what he needs to clear the good at destination. Hidden cost. Compliance with non-tariff barriers often involve additional costs, of course, for certification, for testing, for documentation, which, if not planned for, can reduce profitability of the exporter. How do we prevent this? Do your research. If you are funding as a bank, do your research. Do your research. Understand the specific regulatory requirement of a target country and ensure the customer is meeting that. The customer should do his research also. Align product standard. Adjust production, packaging, and labeling to meet the requirement in the export market. Stay updated. Regulation changes frequently. Regulation change frequently. Exporter must monitor, update, and adapt accordingly. Obtain required certification. Ensure compliance with food and safety quality and environmental standard required by the importing country. Working with experts. Engaging export consultant, freight forwarder, and regulatory advisor familiar with the destination market rules. Test and inspect product. Conduct pre-shipment inspection and lab testing. In fact, this is one very good way the bank can. That's why the bank should, of course, be interested. Where is the document? Where is the regulatory requirement? What is the regulatory requirement and where is the document that shows that this has been met? That means you have to be familiar with it. If you're a banker, you are funding. And if you're the exporter, of course, you definitely need to know this before doing the shipment. Key insight, in 2026, non-tariff barriers are more often restrictive than tariff. Successful exporters are those who understand and comply with this hidden requirement before entering the international market. Now, like I said, this explains the reason why it looks like we have a lot of agreement, but it's not being maximized. It's not being maximized. Poor record keeping and audit trail was the mistake. This occurs when professionals fail to properly organize, maintain, and store record of international trade transactions. Some banks have decided to scan and have digital copy. Even after many years, they can still have access to it. Digital copy, because the hard copy will have been moved to archive because they can't keep keeping it in the head office. Trade activity generates a lot of documents. Invoices, bill of lading, packing list, contract, purchase order, inspection report, compliance certificate, payment record, different documents. Poor record keeping include missing or incomplete documents, disorganized filing system, lack of traceability of transaction, inability to retrieve documents when needed. In many cases, there is no clear audit trail showing how decisions were made. This is the whole essence of digitization. Some banks have been able to do this very well. Some that do manual have to now write whatever been done in this file on the inner page of the file, of the cover of that file, to be able to ensure, and because it's human, right? some of this information sometimes are not included and you don't really have, which is why most of the time you want to print and put it inside, file all the document relating to whatever has been done to make it easier for whoever it is that reviewed the file to be able to know what has happened on the file. Why is this a serious problem? Regulatory risk. Authority require business to maintain record for compliance check. Missing record can lead to fine, penalty, and sanction. Audit failure during internal and external audit, lack of proper documentation can result in non-compliance finding. Financial risk in dispute, inability to provide evidence can lead to loss of claim and payment. Loss of claim or payment. Operational efficiency. Operational inefficiency, a poor documentation slow down processes, and of course, decision making. Reputational damage. Weak record system reduce confidence from banks, partners, and regulators. So how do we fix this? Establish structured record system. Create organized filing system. Like I said, some banks are digitizing this. They have giant scanner scanning this and putting them in the cloud such that they can easily search for it in the cloud and locate the file, the digital copy, so that the hard copy can live. So even 5-10 years ago, you can still find it. Define retention policy. Maintain record of required regulatory period, often 5 to 7 years or more, depending on jurisdiction. Implement access control. Restrict monitor access to sensitive documents to maintain integrity. Adopt digital document management. Use secure system to store, track, and retrieve documents efficiently. And like I said, because we are going towards digitization, this is now even more important. This is now even more important because we are going towards digitization. We're going towards digitization. It's already happening and it's on us already. I see this getting to us probably before the end of this decade, most likely before the end of this decade. We just have about 4 years to the end of this decade. We might be able to have it become a norm, not just in the world, even in Nigeria. End-to-end traceability, clear record of every stage of a transaction from contract to payment, and conduct regular the periodically review record to ensure completeness and compliance. This is one of the old lessons of exchange control document that we always ask our customer for bankers here to be able to bring back after shipment, just to ensure we have all the documentation required showing the evidence of proper utilization of the the forex rather in the market. Key insight in trade compliance: if it's not documented, it's treated as not done. Strong record keeping is essential for accountability, compliance, and risk management in global commerce. Number 8, inadequate compliance training. Like I said at that time about training. Human being, we are learning machine. And because landscape is always changing, one thing you cannot afford also in the new year, in 2026, is building your capacity. Building your capacity. Building your capacity. This occurs when organizations fail to properly train staff involved in international trade on compliance requirements. Employees in trade, operation, finance, logistics, sales may lack understanding of sanction regulation, export control laws, documentation standards, trade rules. Training is often treated as one-time activity rather than continuous process. And this can even happen within the bank or institution in the morning, maybe once a week. As a result, staff rely on outdated knowledge or assumption, increasing the risk of compliance error. It's so important. You know, someone said, if you are not updated, you'll be outdated. Very interesting quote. The idea basically is for us to ensure we are regularly updated. I know a number of us can be very busy, but you know, it's still important that even though you're busy, you're still doing what you think is necessary for whatever it is you're doing to stay relevant, actually, because it's all about your career, to stay relevant and be able to add value to the organization. So if the organization is not doing it, you want to do it for yourself. After all, if for any reason you leave the organization tomorrow and find yourself somewhere else, it's your skill that you're going to now go with. I mean, what you have developed, you go with it. So it's not really about the organization in developing yourself. And nowadays, there's a lot of information available. We're having a session here. You can go on YouTube. You can do certification program. There's so many options available for you to be able to ensure you are in the know. Why is this problem serious? Operational risk. Untrained staff are more likely to make errors in documentation, classification, and transaction processing. Some of the issues that some banks have right now in court were because of what we're talking about here. As in, just some error. Sometimes whenever I talk to bankers, and particularly when there are issues with trade transaction, losses, whatever issue is it, you always notice, I notice a pattern, you just notice a knowledge gap. Sometimes it might look, for those of us that are experienced, might say, why will someone not know this? But common sense is not common. It's not common, particularly considering the fact that a lot of people are leaving the country, professionals and newer people from other units or from even straight from camp school are coming in. So there's this knowledge gap sometimes. And sometimes the way you handle some transaction, particularly as bankers, you are sitting on the keg of gunpowder. It has not just exploded. I was at a session with some bank recently, and a guy made that statement. He said, look, he's just lucky. He just counts himself as being lucky, as in he's lucky. Because you can see that, look, I've been doing this thing this way, and this is the danger. And for like 3-4 years, it has not crystallized. But for some will not be that lucky. Some will not be that lucky, and it might mean they go to court. It might mean they take the bank to court, or the customer take them to court, and it might result in financial law for the organization. Lack of awareness can lead to violation of sanction, export control, and custom regulation. Financial law mistake can result in shipment delay, penalties, or non-payment in trade finance transaction, reputational damage. And that's the big one for organization. And for financial institution, we rely a lot on our reputation to do whatever it is we are doing in business. Repeated compliance failure reduce trust with banks, regulators, and international partners. Increased scrutiny, regulator increase organization to demonstrate that employees are adequately trained. Failure to do so can worsen enforcement outcome. But it's important we also take our career destiny into our hands. So if the organization has constraint with budget, we should not have constraint with budget for ourselves and for our career. How do we prevent this? Implement continuous training programs. Conduct regular training sessions to keep staff updated with evolving regulation and industry practice. Use practical case studies incorporating real-life scenarios and simulations to help staff understand the compliance issues. Assess and certify competence. Conduct periodic assessment to ensure staff understand key compliance concepts. Role-based training. Tailor training to specific role to ensure relevance and effectiveness. Leverage e-learning and digital tools, providing accessible training platforms that allow employees to learn and reflect knowledge regularly. Encourage a compliance culture. Promote awareness that compliance is everyone's responsibility, not just the compliance department. Key insight, 2026 compliance is only as strong as the people managing it. As the people managing it. As the people managing it. Well-trained team are the first line of defense against costly trade compliance failure. And interestingly, at the Institute of Export and International Trade, there is a certification program that focuses a lot on compliance. It's at the intermediate level. It's called Certified Intermediate Professional, which we talk about when we're rounding up. But it covers a lot about this compliance issue that can help boost that skill. Aruna, your hand is on the screen and you are messing up my screen. All right. Number 9, over-reliance on manual processes. Remember, I've talked about digitization of trade. We should not be loyal to what is working. We should be preparing for this digitization before it happens, because it is happening already. It's not like it's going to happen, it is happening already. This mistake of common organization depend heavily on manual process, spreadsheets, emails, paperback check to manage trade compliance activity. Key function handled manually often include sanction screening, document verification, transaction monitoring, record keeping, and monitoring. Manual systems are prone to human errors. Manual systems are prone to inconsistent check, and manual systems are prone to delay in processing. In complex trade environment, manual method cannot keep up with the high transaction volume and evolving regulatory requirement. With high transaction volume and evolving regulatory requirement. Why is this serious problem? Why is this serious problem? Why is this a serious problem? Error risk. Error risk. Manual data entry increased likelihood of mistake in documentation screening and reporting. Compliance gap. Inconsistent check may lead to mis-sanction hit or notice discrepancy. Operational inefficiency. Manual process slow down transaction, causing delay in shipment and payment. Scalability issue. As trade volume grows, manual system become unsuitable, unsustainable rather, and difficult to manage. Become unsustainable and difficult to manage. Regulatory exposure. Regulator expects robust, reliable compliance system. Reliance on manual process may be seen as inadequate. And nowadays, there are a lot of technologies helping to fix a lot of issues with trade transactions. From intelligent document processing and advanced OCR, that's optimal character recognition, to robotic process automation, to artificial intelligence and predictive analytics, to blockchain and distributed ledger technology, to open API programs, and real-time vessel tracking and dynamic screening engine. There's so many tools, technology available to be able to ensure we reduce our manual processing as much as possible. Adopt automation tools. Implement compliance software for sanction screening and document validation and transaction monitoring. Use integrated systems. Connecting trade operation, finance, and compliance system to ensure seamless data flow and consistency. Leveraging AI and data analytics, utilizing advanced technology to detect anomalies, flag risks, and improve decision-making. Standardized process. Develop automated workflow and checklists to ensure consistency across transactions. Digitize documentation. Moving from paper-based system to digital document management platform for better accuracy and accessibility. Training staff on technology, ensuring employees are equipped to use automated system effectively. In 2026, manual process alone cannot support effective trade compliance. Automation is no longer optional. It is essential for accuracy. It's essential for speed. It's essential for regulatory confidence. The last one before I close, treating compliance as back office function. Treating compliance as back office function. This organization view trade compliance as a support or administrative task, handled only by compliance or operation unit after transactions are initiated. Compliance is excluded from strategic decision-making, from the structuring of the deal or trade finance, and even client engagement. Business, sales, and relationship team proceed with transaction without early compliance input. You know the implication? As a result, compliance become reactive. Checking document after the deal are agreed, rather than proactive in shaping risk-aware transaction. Compliance is seen as a back office function, not seen going hand in hand with other stakeholders engaged in financing the transaction. Why is it a serious problem? Financial loss. Reworking transaction, amending documents, unwinding deals increase cost and may result in lost revenue. Late detection. Issues like sanction, export control, documentation gap are discovered too late. leading to deal delays and cancellation. Regulatory exposure. Lack of early compliance involvement can lead to breaches of sanction, anti-money laundering, and custom rules. Inefficiency. Repeated back and forth between the teams. Slow down execution and frustrate clients. Reputational damage. Inconsistent compliance outcome erode trust with banks, with partners, and regulators. Missed opportunity. Risk averse. Last-minute decision may block otherwise viable deal that could have been structured compliantly from start if we have engaged with these guys. So compliance should no longer be back office. How do we prevent this? How do we prevent this? Embed compliance early in the transaction. Ensure they are involved early in the transaction. Involve compliance at the deal origination and structuring stage, not just at the documentation stage. Not just at the documentation stage. Governance framework. Establish clear policy where high-risk transactions require upfront compliance sign-off. KPI and accountability. Include compliance metrics in business unit performance goal. Cross-functional collaboration. Integrate compliance with sales, operation, and finance through joint flow and approval. Use pre-checks. Implement early sanction, country, and product risk assessment before committing to the transaction. Technology integration using systems that embed compliance check into transaction workflow in real time. Key insight. In 2026, compliance must sit at the core of business strategy. When embedded early, it accelerates deals. When embedded early, it reduces risk. When embedded early, it enhances credibility, and therefore turning compliance from a constraint, but rather into a competitive advantage. So compliance can actually give us a competitive advantage because then we can be faster and a lot better in the way we handle our trade operation. Before we round off, let me talk about some of the program of the Institute and entertain some questions. Here are some of the program. If you are joining us for the first time and you're hearing about the Institute of Export and International Trade, you can become a chartered trade specialist doing the basic program, intermediate program, advanced program, finance program, and export program. Each of them having 15 units, but the export program having 40 units. And with 100 units, you can become a chartered trade specialist. This in conjunction with the International Chamber of Commerce, a global body in more than 170 countries. Right now, we have IC in 170 countries, and they're part of this program. The basic, the intermediate is the compliance issue we've talked about today is embedded within the intermediate. And for those that have been in trade or handle trade transaction for some years, this might be the program you might want to consider, particularly if you need more understanding as far as regulatory issues, compliance issues is concerned, both on trade-based money laundering, terrorist financing, and sanction is concerned, then intermediate program will be very good. I also mentioned UCP earlier because another area is in the trade rule, and that's what you have in the Certified Advanced Trade Professional, where you have different rules from UCP to URC to URR to ISBP to URDG to EUCP to Incoterms about 8 of them, actually, I think 8 or 9 rules that you find within Certified Advanced Trade Professional programs. And here are the details. But at this program, there is a discount for those that will be interested. The tutorial or the platform where you learn for this program is $150K. And for those that are interested here, have a discount of 50%. That means you'll be paying $75 that's $75 discount on the fee for the program. So that means for the intermediate program, for example, advanced program, for example, you have a 75,000 naira discount on that. But the beauty of this also is that it allows for flexible payment. You can spread your payment over 1, 2 months, 3 months, 4 months, 5 months, 6 months, as it's convenient for you. Why? Because, of course, we know we are salary earners and we have planned for our finances, and you might want to consider any of this program. And of course, like I said, you get a discount. As I conclude and take question. In conclusion, if as trade professional in 2026, you want peak performance in trade career, purposeful progress in your trade career, professional prestige in your trade career, and prevent problem in your trade career, then you must avoid this mistake in 2026. Thank you very much. Let me take some questions before we close. And then, of course, feedback. We appreciate your feedback. This will be a continuous program for the Institute, and your feedback will be very, very important. My colleague has dropped a link on the chat. We appreciate other topics you want us to treat in the coming months. We want to make this once in 2 months, 3 months, or even every month, as the case may be, depending on the number of topics we need to treat. So the link that has been dropped in the chat, it would be great if you can use that link to be able to ensure that you fill in the details to be able to let us know other emerging areas that you feel will be of interest to you for seminar we'll be doing in future. So we'd like to hear from you. Any comment from what you've learned so far? Anybody that wants to drop a comment or have a question? You can indicate raising up. Okay, I can see one hand. You can indicate by raising up your hand, or you unmute yourself. Any question or comment? Okay, let me call name Abasi Freke. How was the session for you? Abasi Freke, are you there? Hello, Abasi. Awelewa. Awelewa, how was the session for you? Okay. Okay, someone said very insightful. Roosevelt, thank you. Yes, go ahead.
I was having issues on muting myself.
All right.
It was very insightful for me, especially that I handle documents. So
Okay.
I'm learning a lot, and I really enjoyed the session.
Oh,
Thank
fantastic. Thank you. Thank you very much. Thank you. All right. Awelewa, are you there? How has been the session for you?
It was very insightful. I learned a lot. Thank you very much.
Thank you. Thank you very much. Chidebere. Chidebere, how was the session for you? Hello, Chidebere, are you there? Okay. Damilare, how was the session for you? Okay, Akinyemi. Good evening, sir. Akinyemi, how are you? Thanks for joining. How was the session for you? Hello, Akinyemi, are you there? Okay.
Okay, magnificent. Sorry.
Okay.
Apologies. I was trying to mute.
Okay. Okay.
Wonderful session. I mean, your sessions are always wonderful. And it's a learning experience. A lot of things that we overlook, in the course of work.
Yes.
Comes to compliance, and one of the things that we realize, even in the banking sector here, I really think that you should have this session, especially for compliance units in banks also. Yes, it's important. That due diligence, trade due diligence, we still don't
do it as much.
Handle it exactly, here and stuff. And it affects the integrity of our trade business in Nigeria.
Yeah.
I mean, so I really think it's something that I would recommend. And I really think compliance units should actually latch onto this. It would really help their business, even regulatorily with the CBN. Generally, I think it's very important.
Thank you. Thank you very much. Roosevelt, yes, the recording will be available. So you have access to the recording. And the presentation slide, my colleague will send the presentation slide to you. And if you want the recording also, it will tell you how to get the recording. You have access to it for free. It's a free webinar, so you have access both to the slide and recording. Thank you. Eukarya Metu. Eukarya Metu, I hope I pronounce your name well. Hello, Eukarya. Okay. Felix Okonko. Hello, Felix. How was the session for you? Yes, Exiba, go ahead. I can see your hand.
Yeah, thank you so much, sir, Dr. Dilly. So
Yeah.
I dropped a chat. Mistake you mentioned, the one you spoke on buyer, I missed out that part.
Okay, that was when I spoke on buyer. The first mistake was, the second one was on letter of credit rule. The first one was on ignoring sanction screening beyond the buyer. Is that what you meant?
Yes, sir. Yes.
All right. Okay, Jeffrey. Hello, Jeffrey. Are you there? John Umo. Hello, John. How was the session for you? Kindly help us with the feedback form and other topic you want us to treat. We want to make this a regular event. So let us know other topic that you think will help, particularly on emerging issues as they affect trade globally. I'm sure we'll do the research and work on it for us to have in subsequent sessions. Yes.
The session was good. I enjoyed the session.
Thank you. Thank you very much. Lady Jane. Hello, Lady Jane. Are you there? Lady Jane?
I'm here. Sorry, I was trying to unmute.
Okay.
Okay, it was quite an insightful section coming from strictly AML, CFT, and compliance background. I got to learn lots of.
All right. Thank you. Nsege. Is that Nsege? Is that Echo? Nsege, are you there? Mr. Dikbo, good to see you.
Yes, I'm here.
Okay, Ekpo,
I'm
okay,
here.
go ahead.
Yeah, so as always, it was a good one, a good refresher. My only challenge is that, this is the American Institute is a separate track, the London Institute is a separate track. So you need to kind of difficult. But other than that, the session itself was good.
Thank you very
Thank
much.
you.
Yeah, Mr. Dikbo, good evening. Good to see you, long time.
Good evening, sir.
Good
Yeah,
evening.
far away from trade, so
Yes, you have moved far
it's a
away
big
from us, so
reminder.
you have moved far away from us.
Thank you very much.
All right, thank you. Ramat, good evening. Hello, Ramat, how was the session for you? Ramat, are you there? All right.
Yes, I'm here. Good evening.
Good evening.
I'm still reeling from everything you've poured into us today. So just like every other person has said, it's been a very insightful one. So many times we tend to overlook discrepancies and continue to use waivers. We should actually ensure that we review documents properly.
Yeah.
So thank you very much for pouring out from your wealth of knowledge to us. We sincerely appreciate it.
Thank you. Thank you very much. All right, because of our time, thank you very much, everyone. You'll be hearing from us for subsequent, but like we said, your feedback is important, particularly suggestions on other topics in trade related you want us to look at in future. Thank you very much. Have a good evening. See you next time, and bye-bye. Over to you, Victoria.
All right. Thank you so much, Dr. Bamidele, for this session. Everyone, said it was insightful, and I also say it's empowering. It was empowering. So we look forward to next sessions, and we know many more professionals ready to learn from the wealth of knowledge. knowledge, sir. Thank you once again, sir. And
Good. I'd like to say good night or have a great evening, everyone.
All right, bye-bye.
Bye.
So the presentation slide will be available. My colleague will send it to you. I mean, we have your email. And of course, if you want the recording also, he will tell you how to get it on our e-learning platform without having to pay. Thank you.